Hello, friends. Welcome back to the Kuderna podcast. I'm your host, Bryan Kuderna. So, if you're new to the show, let me just fill you in. This is where we talk about all things wealth. And I define wealth in its original meaning, a state of well being. So, naturally, money plays a role in that. And that's where I come in periodically and put on my financial advisor hat and just share some pertinent finance or economic info that I think all of us should be aware of so that you can make the best decisions with your money and at least check that box off in the financial planning respect. Now, money can't buy happiness, but it certainly goes a long way to making life a little bit easier. And then, of course, we have many cool guests on the show that cover pretty much any other topic from health and sports, writing, creating, you name it. But let's check that financial box. And that's what we're going to do today is share some timely advice, particularly here at the year end, so that you can have your affairs in good order as we conclude 2025 and get off on the best foot possible for 2026. But before I get into today's content, I just want to remind everybody, please like and subscribe the show wherever you're watching or listening today. That's how we can keep spreading the good news and also get some really cool guests on here so that everybody can stay in the know.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
So without further ado, today's episode is titled The Buy, Borrow, and Die Strategy. I know that sounds a little bit morbid, but this is one of those instances where if we can look at the long term and understand the rules of the game, how the economies work, how our systems work, how taxes work, kind of the framework of finance, and then really look way down the road, frankly, when we're not here anymore, and then start to work our way backwards, that can give us a lot of opportunity that we might not see otherwise if we get stuck just in the here and now. Now, I do want to preface that tax law is constantly changing, just as everything else in economics is. So the information I'm going to share today, it's what we know here and now in 2025. All right. So definitely keep this in mind. It's a good strategy. It's something to be aware of. However, know that, the rules of the game, they can change. So you just want to keep your financial plans, of course, up to date as well. So what is the buy, borrow, and die strategy? All right. It has to do with how you actually hold your investments. Do we buy, sell, or hold? Okay. This is a strategy that everybody should understand. And we're going to get into why. All right. As I am sitting here recording this episode, it is November 17th, 2025. Where are we year to date? The S&P 500. All right. So those are those 500 massive companies, your blue chip stocks. It's probably the most quoted stock market index that there is. The S&P 500 is up roughly 14% year to date. So it's a pretty good year. And in addition to that, don't forget, we're coming off back-to-back years of 20% plus returns in the S&P 500. So the stock market has been on an absolute tear, to say the least. Now, you might be saying, okay, well, we're sitting here mid-November. It's not even Thanksgiving yet. The S&P's up about 14%. Just a week ago, that number was about 16%, mind you. So do we have the wherewithal maybe to climb a little bit higher and hit 20% yet again and essentially get a three-peat? Okay. Keep in mind, as you're thinking about what does my portfolio look like? How aggressive am I? How conservative am I? What is that split? Am I a 60-40, 70-30? What do I want my investment profile to look like? And we have to constantly keep tabs on that. And that's where often, you yourself or with your advisor might be talking about rebalancing it and make sure that your portfolio stays in line with your investment goals and your risk tolerance. Okay. Naturally, when the market has such a run like this, those equities positions, okay, what's in the stock market is climbing and climbing and climbing. Meanwhile, whatever you have in fixed income and bonds is obviously not going up that quickly, or perhaps is a little more flat. So that can create a portfolio that naturally gets overweight. So we started maybe as a 60-40 type of investor, and now maybe we're closer to 80-20, 80% in the markets, only 20% fixed income. So suddenly we've gone on that risk scale, maybe from like a 6 to an 8 without even really, noticing it or wanting to. It just kind of happened by virtue of this bull market that we're living through. So you say, well, what do I do? Maybe I want to rebalance. Maybe I want to lock in some gains. I'm starting to think about making changes to my portfolio. But what are the consequences to that? And what are the costs of doing so? And that's where this strategy is going to come into play. Now, I mentioned the potential for a three-peat this year, back to back to back 20% plus returns in the S&P 500. Just for context, guys, that has only happened one time before in history. And believe it or not, there was actually a four-peat. Okay. It's the only time ever. It happened 3 years in a row. And obviously the only time ever 4 years in a row. And that was the years 1995 to 1998. All right. Probably the greatest run in stock market history. Are we going to mimic that? Maybe. Only time will tell. But again, you just want to stay in the know. You want to be prepared, whether it does or it doesn't. All right. And another thing to keep in context before we get into the actual strategy today is as we look at the markets and economics as a whole, again, there's only been one three-peat in history. We have the possibility to get that with a good end here to November and a strong December. All right. But then the other thing to note is right now we are kind of in the Trump 2.0. All right. This is one of the only times in history where we've had prior experience with a president that was not the last president. That wasn't Joe Biden. So if we go back to Trump's first term in office, he only had one negative year in the stock market. And that was his second year of his presidency, which was 2018. In 2018, the S&P finished negative 6.2%. The other 3 years were very strong. So I'm not saying that history is bound to repeat itself. If you read any financial disclaimer, it's always going to tell you that past performance will not indicate future performance. But if you just want to kind of draw some sort of parallel there for people who do follow kind of historical trends, Trump's second year in office was the only negative. And of course, next year, 2026, will again be his second year in office for his second term. So just kind of keep all these factors in mind. Again, I'm not saying that the market's going to go up or down. I'm not saying it's time to pull our chips off the table or to even put more on there. It's just an understanding of the current climate that we're living through right now and investing through. So this strategy that I'm describing, the buy, borrow, die strategy, what this pertains to is what are called non-qualified or non-retirement investment accounts. Okay. In short, they're assets that are not growing tax deferred or tax free. They are subject to capital gains taxes. Okay. So that's kind of the prerequisite for what I'm about to describe. So when you have an asset, whether it be real estate, an individual stock or bond, or you're just looking at your brokerage account that's got a whole mix of funds in there, and you're saying, all right, some are doing better than others, but I want to make some tweaks here. Whenever you're going to then sell that investment, let's just use a stock, for example, you are going to be subject to either short-term capital gains or long-term capital gains. Okay. Short-term capital gains is pretty easy. All right. That just means that you held that investment for less than 12 months. Okay. So if you bought a stock in January and you want to sell it right now, okay, we're obviously within a 12-month window or inside of 1 year. If there was a gain in that investment, it's going to be a short-term capital gain, which simply means that that's going to be added to your ordinary income, which for most people, that's the worst type of tax that we could face. So that's bad. That's almost like the government, the IRS, is punishing you for short-term trading. And if you say, well, that seems unfair, it seems like they are actually punishing me. That's because they are. Typically speaking, short-term trading is not necessarily advisable, and it goes against the grain of long-term investing. And that's obviously what helps the economy and companies, is to have long-term investors. Okay. So short-term capital gains, just add it to your ordinary income and you go from there. Long-term capital gains, okay, which is more favorable. All right. The economy wants long-term steady investors. as do any publicly traded companies. And so the government, the IRS, is a little bit more friendly in that respect. If you hold an investment for longer than a 12-month period, so for over 1 year, and then you trade that at a gain, or you sell it at a gain rather, you will be subject to the long-term capital gains tax. Now, as of right now, and again, these things change, but in 2025, just to clue everybody in, if you're married filing jointly and your taxable income is under $94,050, or if you're a single filer and your income is under $47,025, then you have a 0% long-term capital gain tax. That's awesome. Good for you if you had a gain and you don't have to pay taxes on that gain. For most folks out there, if you're married filing jointly and your income is between $94,050 and $583,750, you are going to pay a 15% long-term capital gains tax. Okay. So again, that could be much, much better than paying upwards of a 30% tax if the same exact investment was a short-term gain. All right. So 15%, that's the capital gains tax rate for the majority of investors out there. And then if you're over that limit, all right, if you're over $583,750 of income, or if you're single and you're over $518,900 of income, then you will be subject to a 20% long-term capital gains tax. And now, if that's not bad enough, on top of all that, some investors could be subject to what's often called the Medicare tax. Right? The technical name is the NIIT, which is the net investment income tax. Okay. That's an additional 3.8% tax on certain investment income, such as interest, dividends, capital gains, passive rental income, things like that. Okay, so capital gains is kind of what we're focusing on here. And that's for taxpayers whose modified adjusted gross income, or their MAGI, is over the following limits: $250,000 if you're married filing jointly. Okay, so keep those things in mind. I mean, we're talking if you're a high earner and you're like, man, I really want to tweak my portfolio. I'm trying to do the right things. I've held my investment for the long term. Now I want to sell it. And that profit is getting subject to a 20% federal capital gains tax, a 3.8% Medicare tax, and then any additional capital gains tax that your state or locality may subject you to. So that stinks as an investor. I get that. You're looking at your portfolio saying, man, I've got 3 years in a row here where we're doing really well, but to try and be smart with my money and make an adjustment that I want to make, I'm now essentially paying a toll. And it can be pretty hefty for some investors out there. So that brings into question, what do we do? How do we handle this situation? Well, let's keep things simple. Okay. You essentially have three options. You can either sell it, you can donate it, or you can hold it. That's pretty much it. If you boil it all down, those are the three things you could do with your investment. Continue to hold it, donate it to a charity that you love, or sell it and kind of go from there. So if you said, you know what, I want to hold it, then don't worry about anything I'm describing right now. You continue and reevaluate the situation in the future. And that's going to bring in the ultimate name of this strategy, the buy, hold, and die. But let's look at the other two options real quick to kind of get them out of the way. All right. Let's say that you want to donate it. All right. This is something that a lot of folks want to look into. Number one, the charity, your cause should always lead the way. I always try and tell people that. Don't just simply do something for tax purposes, but give it some thought as far as, where do you want that money to go? Is it a cause you believe in? Okay. Because you're giving up, that's a donation. You're giving up that asset that you give to the charity. All right. So they have to be what's called a 501c3. And remember, charities, 501c3s, do not pay taxes. Okay. So what you could do is you've had that stock or whatever investment that's appreciated greatly over time. You're sitting there saying, man, I do not want to sell this because the capital gains tax is going to be a huge hit. So what you could do is actually take that stock, take that marketable security, and you donate it to that favorite charity of yours. Now you get two, or you really get three benefits here. One, you're helping that cause you love. Two, you're not paying any capital gains tax because you did not sell the investment. Three, if you itemize, you're getting a deduction for a charitable donation of whatever the value is of that asset. Okay. Now that you do need to speak with your CPA or accountant on, there can be limits as far as how much you could deduct, whether you itemize or claim your standard deduction. You definitely want to go over that with your tax advisors, but just know that that's an option. You can donate that appreciated security or investment, no capital gains tax. There may be a nice deduction there. All right. So that helps you out with your tax return, and you've helped out your charity. Okay. So that's a great option. And another one too, that maybe we'll do another episode. You guys, if you give me some feedback or whatever, communicate on social media or in the reviews. There's also an option called a donor advised fund. So maybe some of you are out there like, yeah, I've always been thinking I want to set up my own foundation for XYZ causes. Or I don't want to go that far. I don't want to have to create this whole thing, this whole 501c3. So instead, I'm going to set up a DAF, a donor advised fund. And then what that allows you to do is contribute or donate to that fund that you've set up. And then you can get deductions here and now in this year. And then you can take your time and decide, what do you want to do with those monies? You can continue to invest them. You can then, give them in the future to another charity or cause that you support. So that's a donor advised fund. A lot of really cool things you could do with that to help and also get some tax benefits. And again, not pay capital gains. So that's one option, guys. You can donate it. The second option is going to be, I want to sell it. I want to keep that asset. I want to keep it in my world. But I want to change it. I want to cut it loose. I'm making adjustments to my portfolio, so I'm going to sell it. Most people are going to say, well, if you got a big gain there, look into tax loss harvesting. Okay, that's kind of the knee-jerk reaction. You want to do some tax loss harvesting. It's a fancy term. All that means in short is that you're going to have your losses in your portfolio offset some of your gains in your portfolio. All right, so let's say that I have stock A and it's appreciated, $50. That was my capital gain in that position. And then I have stock B, which has fallen $50. It hasn't performed very well. So I want to make adjustments to my portfolio. I want to sell stock A because I don't want it anymore. I'm happy with the gain that I got. So maybe then I want to sell stock B at a loss. And then that $50 gain and $50 loss, those will offset. And so now I do not have to incur a capital gains tax. All right. That's a simplified example, but that's ultimately what it is offsetting gains and losses so that you do not have to pay so much in the way of taxes. Okay. Now, something I'm always telling clients of mine, and I adhere this to in my portfolio, I look at tax loss harvesting as a happy byproduct. If my changes that I want to make in my investments generate that opportunity for offsetting, then great. Maybe I can, mitigate some of the tax bite there. However, I don't want to let what I call the tax tail wag the investment dog. Selling at a loss, that's kind of counterintuitive to everything you want to do as an investor, right? We're investing to make money, to get gains. So you shouldn't be excited that, hey, there's a loser over there I'm going to sell and intentionally lose money on an investment just so I can maybe lower some of that tax bite. All right. So don't let the tax tail wag the investment dog, but be aware of that. If you're in a situation where you want to dial back a position that you've had a gain, maybe you want to cut away a loser that you no longer believe in, then okay, maybe we can naturally offset some of the gains there. That's tax loss harvesting in a nutshell. And one thing that I do want to kind of clarify too and add to that is something called the wash sale rule. Because I'm sure if you're reading about tax loss harvesting, you've come across this. And essentially what that says is the IRS is kind of wised up to you saying, you know what, I'm going to sell this loser over here, all right, stock B in that prior example. And then I can take that loss and write it off against my gains. And then I'll immediately just buy back stock B. And so I got the best of both worlds. I didn't lose money. I went right back into the position, but I got to, offset or write off that loss that I realized just in that quick sale I made. That's called the wash sale rule. That's not allowed. What the IRS says is that if you're going to sell something at a loss, you need to wait at least 30 days before you buy back that same position or something that they consider substantially identical. Okay. So just know what the wash sale rule is. If you're trying to get cute and think you found some sort of loophole here, the IRS knows what that is, and they're not going to let that fly. So you need to be careful. And this is why you need to work with advisors and your tax advisors as well. Okay. So that's tax loss harvesting. That's the wash sale rule. Just keep those things in mind. That's what you're going to be subject to if you want to sell it. Okay. So we went through option one, donate it. Option two, sell it. Maybe we can look into tax loss harvesting. But frankly, the thing we're running into right now, remember I said, 2023, awesome year in the markets. 2024, another great year in the markets. 2025, we're up 14% as I'm talking right now. There's a chance you're looking at your portfolio and saying, I don't see a loser. I don't see anything that's going to give me that option. That's very possible. So now we have the third and final decision, and this is simply to hold on to the investment. And this is where the idea of buy, borrow, die comes in. Okay. So buy, naturally, what that means is we're going to buy an asset. Could be real estate, could be a stock, a bond, whatever that asset is. And then we're going to borrow. Why am I saying borrow? Because ultimately the utility of any asset or any investment is to be able to use it for your own benefit or your family or whatever your causes are at some point. So if you're saying, well, I'm looking at my portfolio, it's grown a lot and I want to use that money for, you name the cause, putting your kids through college, buying a second home, fixing your car, whatever. And you say, well, if I want to get that money out, I've got to liquidate it. I've got to sell that stock. And now all of a sudden I'm paying all these different taxes and things we described. The alternative is you could borrow. Okay. Take it on your portfolio. You could have what's called a securities-based line of credit. Okay. What that means is essentially you have your investment pledged as collateral there. Okay. Say you have a portfolio of $1 million. All right. And you say, I want to get $100,000 because I'm buying into a practice or some business or whatever. You could possibly get a line of credit against that portfolio. All right. Where now you can draw on that and you could take out $100,000 as a loan, typically against whatever the firm is that you're investing with. They give you the 100 grand. That is a non-taxable event. You spend that $100,000, however you so choose, paying off debt or whatever it might be, and then you repay that loan. Okay. That's a securities-based line of credit, okay, against your portfolio. A lot of people out there are familiar with a home equity line of credit, okay, or a home equity loan. Same concept. Now we're using real estate, where you say, I'm getting the equity out, I'm getting liquidity to go pursue these different goals or whatever, non-taxable event, and then I repay that loan or I repay that line of credit, okay? So that is a way to keep your investment intact. You're not selling anything. You're not incurring any capital gains taxes, and you're getting liquidity out of it. You can also do that with cash value life insurance. Take a whole life plan. You have substantial cash value inside of there, and you want to use it. Yes, you could withdraw those monies, or you might want to take a loan against the policy or a cash value line of credit, maybe through a bank. Same thing, non-taxable, gives you liquidity, you pay back the loan. Now, you definitely want to keep in mind, you got to understand this, guys, the interest rates and, of course, the terms of that loan are critical. The riskier the asset, the riskier the loan. If you have $1 million portfolio that's all in equities, you take a loan against that, there could be what's called a margin call. What that means is that whoever you're investing with, whoever that investment company is, they call that loan because maybe you owned $1 million of XYZ stock and the market corrected and went down 20%. Now there's only 800 grand in your portfolio. They may contact you and say, hey, we're calling the loan. You need to pay it back now, or we need more collateral in there. You got to make another $100,000 deposit to keep that portfolio intact, keep the loan intact. All right. So those are things that can come about that you really got to be aware of, because you don't want to then have to sell at a loss in that situation just to cover that loan that you took out, that's again where you're not acting rationally as an investor. You're letting these external forces now dictate what you're going to do with your money. Okay. So you need to be careful with that, but it can be a great strategy for people that want some liquidity. And, as long as their whole financial plan is kind of aware of these different moving parts, it can work well. And again, avoid any potential tax impact. All right. So step one, you're buying the asset. Hopefully it's appreciated in value. That's where this becomes relevant. Then we're going to borrow against that asset. Okay. Rather than sell it, we're going to get a loan. So that gives us our liquidity there. Again, not considered income or capital gains. And then three, this is the morbid part, is we die. Okay. Well, what does that actually mean? Not to get too deep when we're no longer here and we pass away. From a tax standpoint, guys, right now, as we speak in 2025, there is still something in the tax code called a step up in basis. This is what's so critical. Let's say that I bought a piece of property or an investment 30 years ago. Okay. Over 3 decades, it's, appreciated tremendously in value. You could name the real estate, you could name the stock. We can all think of some that it's like, man, it's worth way more today than it was then. If I, the owner of that asset, want to now sell it, okay, I'm incurring a capital gains tax. If I bought a piece of real estate along the shore for $30,000 40 years ago, and today it's worth $3 million, think of what the capital gains tax would be. That would be enormous. Same thing. If I bought Amazon or Apple stock way back and I want to sell it today, I might face a gigantic capital gains tax. However, once I pass away, if I still own that asset and I leave that to my beneficiary, okay, I leave that to, you name it, your kids, whatever it might be, they then get what's called a step up in basis. And what that means is basis, okay, the amount that you put into the investment, your initial contribution, okay, that's your basis. Instead of it being, say, $30,000 on that shore house 40 years ago, it's now going to step up to the current market value at the date of death. Okay. So in theory, if I were to sell this appreciated asset today, I get crushed in capital gains taxes. If I were to pass away tomorrow and leave it to my heirs and then they sell it, assuming it hasn't changed in value in a day, they could literally have no capital gains tax because it's stepped up the basis to today's value of at the date of death. Okay. That is so critical. People recognize that. There's a lot of conversation around that. Some would say that's unfair. You could look at super wealthy people that made a ton of money on a particular stock or real estate or what have you. And all of a sudden they're saying, well, there's a huge capital gains there. And then boom, they pass away, their heirs receive it, and there's no capital gains because we've stepped up the basis to the current value. Okay. So that can be a tremendous benefit to that family or to those heirs, in which they may have, by and large, avoided most of the capital gain there for tax purposes. So that is the buy, borrow along the way, hold it, hold it, hold it. And then once we pass away, all right, our beneficiaries get the benefit of that step up in basis. So that's something that everybody should be aware of. Obviously, if we're saying, I'm not doing too well, I'm older now, or I got sick, or whatever it might be, and if I'm going to sell this asset, I'll incur a huge tax. Well, then see, maybe is there a way to get some financing, get a line of credit, get a loan against that, give us that liquidity, all right, no tax consequence. And then once we pass away, all right, then the loan can be repaid and the beneficiaries don't have to pay so much in taxes because of that benefit. All right, so the buy, borrow, and die strategy, it's typically most beneficial for wealthy investors, high earning investors. That's where you're going to see this strategy most, prevalent, okay? Keep in mind, if you're trying to do the borrowing piece, about some of the risk involved with the terms of the loan, and especially if you have riskier assets that could lose value, what that could mean as far as a margin call or other financing costs. So this is just one strategy to consider inside of an overall financial plan, but it's something that should definitely be considered for people who are trying to be tax aware, And this is why you should listen to my show and hear about all the other options, the tax deferred options, the tax free options. You've heard me talk a lot about Roth options, okay, backdoor Roth IRAs, things of that nature, where now you can be the rational investor and not worry about that tax consequence, or be using, permanent life insurance, whole life plans, things like that, where now we can get very, very large benefits that in many cases are 100% tax free, and let that do the legwork of our estate or legacy plans. So then that can give us much more current liquidity, throughout retirement. So there's so many different strategies here, guys, but being in the know, that's 90% of the battle. And so that, in short, is the buy, borrow, and die strategy. Again, think with the end in mind, work your way back to today, reverse engineer that whole process. And then that can give you the advantage of having a very good vantage point, no pun intended, in which you can see kind of the whole picture rather than being so reactionary within the moment. Because usually that's when we make poor investment decisions, and then we just deal with the tax mess as we go, as opposed to having a formulated long-term plan. All right, I hope that was helpful. Again, my name's Bryan Kuderna. I'm a certified financial planner. This is the Kuderna Podcast. Please, again, like the show if you did like it. Subscribe. We always like to have new subscribers here. Keep tuning in. Every once in a blue moon, I throw in these fun personal finance or economic shows. And in between, we have some really great guests that are at the head of their field so that you can continue to pursue wealth and increase your state of well-being. We'll see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey, 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.